Hi everyone, in the last video, we talked about the 3 core principles of technical analysis, as well as its 4 key components. Now let's dive into candlestick charts. Candlestick analysis mainly breaks into 2 types, single candle analysis and candlestick patterns. Let's start with single candlestick analysis, and what it tells us in practical trading. A single candlestick can come in many forms: red, green, big, small, long, short. Each variation has its own message. Candlesticks reflect 4 key price points: open, close, high, and low. They form 2 main types: bullish candles, typically green, and bearish candles, typically red. A long bullish candle means the close was much higher than the open. If there are no wicks above or below, we call this a strong bullish candle or full body green bar. It means the stock opened at the low, closed at the high, and the bulls dominated all day. This is often a positive signal. Next, the long bearish candle. This means the stock opened near its high and closed near the low. The longer the body, the stronger the selling pressure. If this kind of candle breaks down from a high, it's usually a bearish sign. But if it appears after a long downtrend, it might be the final sell-off, a sign that the bottom is near. The bears have exhausted their strength. Market movements are always a tug of war between bulls and bears. When one side totally wins, the tide may be about to turn. Third, small-bodied candles. This is when the open and close are close to each other, with short wicks on both ends. These usually show indecision and happen in sideways markets with low volume. Fourth, medium-sized candles, a bit bigger than small ones. Fifth, long shadow candles. There are 2 types: long upper shadow and long lower shadow. A long upper shadow means the stock hit a high, but sellers pushed it down by the close. It shows failed bullish momentum, maybe due to resistance or bad news late in the day. A long lower shadow is the opposite. The price dropped during the day, but buyers stepped in to push it back up. The longer the lower shadow, the stronger the support. The longer the upper shadow, the stronger the resistance. Sixth, the doji. This is when the open and close are basically the same. There's no body, just a thin cross. It shows total indecision, no clear winner between bulls and bears. Single candle analysis is the foundation of technical charting. Now we are going to talk about candlestick patterns. This is when you put multiple candles together, form a pattern. You've probably seen tons of tutorials on these. Every pattern comes with classic examples, but in real life, they're hard to catch and often fail. Let me be blunt. Understanding patterns can help, but don't ever rely on them alone to make trades. Why do I say that? Here are a few reasons. Low reliability. Famous patterns like the evening star, engulfing, or doji often don't work as advertised. You'll see cases where you buy and the stock drops, or sell and it rallies. Too subjective. What qualifies as a valid pattern? Everyone draws it differently. You also need to factor in location and trend context, which is very subjective. Ignores volume, time frames, and other key data. If you only focus on pattern shapes, it's like predicting the weather by looking at clouds. Looks cool, but not accurate enough. No clear standards. What's a long body or a short wick? Most definitions are vague. One trader's bullish engulfing is another's nothing to see here. Change the time frame, and the pattern changes too. All of this makes pattern analysis more like storytelling than science. Pros and institutions won't rely on just that. Ignores the most critical data. No volume. A hammer pattern without volume is just cosmetic. No trend filter. A morning star in a downtrend means little macro events, news, or macro shocks can destroy even the prettiest pattern. In short, candlestick patterns are like reading tea leaves without the tea. So why do people still teach them? It's historical. Candlestick charts date back to Japanese rice traders in Edo period. They were visual tools for beginners, simple, intuitive, and easy to teach. But many users don't consider the trend background like spotting a hammer in a big downtrend and trying to call the bottom. That rarely works. Also, many patterns are just statistical coincidences. They look good in hindsight, but they don't hold up in future data. Still, candlestick patterns aren't useless. They're just not signals. They're alerts. They tell you, hey, something might be happening here. They don't say, buy now. So if you use quant systems, trend strategies, or flow analysis, patterns can help as confirmation or filters. If you're more practical, here's my advice. Ditch the visual hype, backtest your patterns, run the data. If a pattern has real edge, keep it. And don't treat patterns as standalones. Embed them into full systems. For example, uptrend, volume spike, hammer, above 20 MA, and RSI below 70. a high conviction setup. Also, don't obsess over shapes. Understand the psychology. Now you ask, was it on support? Was there volume? Was the trend behind it? That's how you make patterns work. So here's the bottom line. Don't worship patterns. Don't throw them away. Use them as tools, not commandments. Test them, see what holds up, and build your system. Make patterns one piece of your strategy or tactical module, not the whole game.